Thanks everybody for joining us today. I just wanted to remind you that this is being recorded. One thing I say at the beginning of all these webinars is please go back and look at this again relatively soon after watching it, especially if you're newer to options trading and or this particular strategy. The reason why I say that is because if you watch it again relatively soon afterwards, some of the nuances will stick into your long-term memory, and if you wait a week, month down the road, it's going to be more like learning it all over again. So it's really important to watch it really closely thereafter getting into this. And welcome to the group, stock trader. Anyway, on to a few things. This is going to be a strategy for choppy, trendless markets. Now, we don't really want something that's really trending nicely. We want something that's kind of chopping back and forth, more or less in a sideways pattern. We also really want high implied volatility for this particular strategy. But let me get a couple of things out of the way really quick. My name is Eric Wilkinson. Some of you may recognize me from Fox Business, CNBC, the Wall Street Journal for my commentary on geopolitical, economic, and market analysis. I actually started trading in college with a psychology degree and then decided to switch it over to finance. After graduating from college, I moved up to the Chicago Board of Trade, started out as a trade checker, but traded my discount brokerage account there and there, and then ended up moving up into the pits and started trading. So I've traded in most markets, most conditions, and I've traded stocks, financial futures, commodity futures, currencies, and options on all of these products in all market conditions. Got to go over this real quick disclaimer. Any opinions, news, research, and analysis or other information contained in here or material provided by Pro Trader Strategies companies and or employees is for general commentary and does not constitute investment advice or solicitation to buy or sell any of these. Basically what this is coming down to is I don't know your risk parameters, I don't know what's in your portfolio, so it would not be responsible for me to just give you a blanket statement on a particular stock or strategy to implement, because it could be counterintuitive to what you're already doing. So take what we teach you in here. We're trying to teach you guys how to swim, not really swim for you. And if somebody out there is just telling you to do a particular strategy, it might not be the best thing for you. It's better to learn how to fish for sure. Anyway, any bottom line is do your own homework, and past performance of any trading system or methodology is not necessarily indicative of future results. People giving me a lot of shout outs here. Do you use a butterfly ratio on a weekly basis? I don't always use the butterfly on a weekly that often. What happened to my ponytail? I never had a ponytail. And Chris says it's been an exciting, very challenging week, but educational. Good to hear. Anyway, so Iron Condor, we want range bound, or it to settle down into a range bound area, and we want high volatility. I mentioned that because we want to see that volatility collapse. What happens is when there's high volatility, it holds off theta decay. So when volatility comes in, we get a lot of premium decay rather quickly, and that's really what we'd like to see in this strategy. The less time we're in this strategy, the better off we are. It's a defined risk strategy. It's going to be great for IRAs. So I know a lot of you guys have been asking about the IRAs. This is a great strategy for an IRA. It's great for a new option trader as well because it's defined risk. You know exactly what your max profit is and your max loss going into the strategy. So it's great for that. And it's an all-around great strategy. It's one of my favorite for sure. Basically how we're building this out is you take a call spread and a put spread and you kind of jam them together, and that's how you can create this. It's also a strangle, which we've just done, and I know I see a lot of people returning. This is a strangle with defined risk, so it's makes it IRA appropriate as well, and I think I mentioned that already. So this is what I'm talking about. You take a short put spread and a short call spread, jam those two together, and you get what looks like these. Now this is what it's going to look like when you're in a low implied volatility market. It's the break evens are tighter, and you actually have to, the short calls that you have are going to be really close to where the underlying is trading. So when you have high IV, those premiums get pumped up, and we're allowed to get further away from where the underlying is trading at the current time, which is going to increase our probabilities of success. So keep that in mind. That's why it's so important to have high IV in this. Anytime we're collecting a credit, we want high IV so we can get further away from where the underlying is trading. And when IV reverts back to the mean, then our Iron Condor starts making money, and rather quickly if we can time that nicely. So like I mentioned several times already, and I can't stress this enough, we really want high implied volatility, and we want it to contract or remain steady. The reason why we don't want it to expand or go higher is because that holds off that theta decay, and the whole thing with this strategy is theta decay. We want theta decay to happen. Essentials for success. A lot of you guys that have been watching this know that I go through these steps, picking the right strike. We're going to be trying to build this strategy by starting at 1 standard deviation away, which is about an 84% probability of being out of the money at expiration. So both sides is where we're going to be starting this, and we're going to be using around a 16 delta. From my research today, it's looking like we're going to have to come inside that slightly to about a 20 delta. So somewhere between the 20 and the 16 delta is usually where I find this strategy works with all my rules. So we're going to kind of start with that. We're going to also look at the right duration. We want to have this theta decay happen. And this is a visual of what happens with theta decay. We really see a 50% drop within 35 days of expiration, and right up until about 10 days to go. So this is a good time to implement this strategy. If we can be in this strategy for less than, I'm finding around 21 days is the best time to try and really be out of this strategy. If we're in this for 21 days, we're going to kind of look to get out of this strategy. The reason why is we start getting in to the closer to expiration, we have gamma risk. So when the market moves just slightly, it really starts throwing our premiums around because gamma's really affecting those premiums. So we kind of want to get out of there before that all starts happening. So we want to take advantage of this theta decay. And as you can see on the chart here, 35 days is optimal. I usually like to get into the strategy with like around 45 days. That's not in the wheelhouse right now. So somewhere between 45 days, 35 days is a good rule of thumb for this one. John O'Rourke said he had a fantastic week. I think a lot of people, if you watch my webinars and you're taking advantage of implied volatility, we had our chance with implied volatility. There's still a few out there that we have that chance, and when we saw a lot of volatility crush this week, and that is the time to really be a premium seller for sure. Picking the right environment. I can't say it enough. Again, I'm going to say high implied volatility is what we want, and we want an IV percent above 50 for stocks and above 30 for ETFs. So we still have that opportunity. The ETFs, there's a lot of ETFs out there right now that have implied volatility, some of them even above 50, which is a really good environment for that. I'm being asked, do you prefer the strangle or straddle? Which is better for the newer traders? I would say that the strangle is better for newer traders for sure. If you're doing the straddle, take less percent of max profit, but I'm going to talk about this with this Iron Condor a little bit later, so kind of remind me about that, my thought here on when you start out with this Iron Condor. I'm going to start out with a little bit tighter call spread and put spread, and then the more you get comfortable with this strategy, you guys, one thing I want to emphasize is if you're not comfortable with like doing the naked strangle, then start out, rather than getting bigger size, like going from, say, you know, a 1 lot or say a 5 lot to a 10 lot and increasing your size using these same rules, start increasing the width of those call spread and put spreads and start stretching that out. That will increase your risk tolerance in a sense to get you used to going to the naked strategies, because that's really where you'll start seeing the premium contraction much faster than with, say, the defined risk strategies. There's a lot of things that go into that because you are also long a call and long a put, then those premiums have a tendency to offset a little bit. So it's better to get a little wider and rather than getting bigger with your size. All right, so picking the right underlying. Picking the right underlying, I talk about this a lot. We want a tight bid-ask spread, which means that if the stock is trading $100 or less, we want that bid-ask to be less than 10 cents wide. And that is a definite rule of thumb. If we're getting up into the $300 stocks, I usually look at, say, you know, put the decimal point in front of whatever it's trading, and that's how wide that bid-ask should be. So a $300 stock would be like 30 cents. You know, price line would be $1.50 or something like that. So keep that in mind as well, just to keep those bid-ask tight, because that means there's a lot of participation in there. And if there's ever anything that starts happening or going awry, those bid-asks are going to get wider. But things like Apple and Disney and the ones that everybody's trading, those bid-asks will get a little bit wider, but there's always somebody in that market that wants to get out or get in and take advantage of it. So they're willing to give up a little bit of an edge as long as you got a lot of open interest and volume going on in those on a normal daily basis. If you get into one of these ones where the bid-ask is a little bit wider, what's going to happen is everybody's going to leave that market and go to the ones where there's liquidity, and they're going to try and make their positions happen around that, and they're going to kind of forget about those in the meantime. So it's going to be harder for you to get in and out. So make sure that you're in strategies that have a lot of players in there. The width of the Condor, it's going to, I'll talk about that. Trevor's asking, will the width of the Iron Condor reduce your credit? Yes and no. It depends on if you're going tighter or if you're going wider. The percent of what you are going to receive decreases the wider you get, but I'll go into all those benefits and everything else from that. And know your exit, all right? So this is something that I want you guys to really take note of. When I'm doing these credit strategies, I'm not ever really taking any more than 50% of my max profit. The reason why is it takes so long and you're incurring so much more risk the further you are in, or the longer you are in this strategy. So make sure that if you can get 50% of that max profit, especially in under 21 days, take that and run. And if you can get 25% of your max profit on an Iron Condor in less than 15 days, that is money in the bank and you've beaten the probabilities. So make sure you keep that in mind when you're going into the strategy. I am not ever looking to take this strategy into expiration and getting every penny out of this strategy. The reason why is I want to beat the probabilities. The only time I'm going to take this into the last couple of days is if this strategy isn't working and I'm waiting for it to come back in between my two short strikes. So that's the only time I'm going to try and take this out closer to expiration. All right, so a couple things to go over real quick. Our max profit is that net premium we receive from building the entire strategy. Anytime you're collecting a credit, that is your max profit. Our max loss is limited because it's a defined risk strategy, and it's our long call minus our short call minus the net premium received, or it's the short put minus the long put minus the net premium received. So it's the difference between the long and short call and the net premium. So if it's a dollar wide Iron Condor, meaning maybe it's the 35-36 call spread where we're short the 35 calls, long the 36 calls, we collect 33 cents for the entire strategy. Our max profit is that 33 cents. Our max loss is going to be that 67 cents. And you got to keep in mind that we have two max loss possibilities because the underlying can't go to both of them at the same time. So, and the break even, same thing. You're going to have one break even or the other, and it's not going to be impacted at the same time ever. But it's our short call strike plus the net premium received. So in that example, our break even is the 35 short call plus that 33 cents. So when the underlying is trading at 35, 33, then that is our break even to the upside. On the downside, our short put minus the premium received, and if we were doing like the 30 puts and that 33 cents, it would be $29.67 to the downside when that underlying is trading there. All right, so enough of the boring stuff. This is where we get into the fun, hopefully anyway. And this is usually where I tell you guys, start throwing it out there for stocks that you guys like to trade. We'll go through my steps to see if it fits in line with those and follow the rules as closely as we can. Generally, do the index options have IV too low for Iron Condors? Well, like I said, with the index options, if it's above 30, then we're good to go. For instance, so I'll throw one of mine out that I was looking at, the Qs. The Qs actually have a IV percent above 30. So that's why I lower that. The reason why with index, any kind of index ETF type situation, it's because it's a basket of the underlyings, and that's going to kind of smooth out some of that volatility. But if you get volatility above 30, then that is a pretty high volatility, implied volatility percent for that particular underlying. Does that make sense for everybody? Because it's a basket. Anytime you get a basket of those goods, then you can look at it above 30. And where is that displayed? Right here. As a matter of fact, you can go up into the gear I have on TOS. You can go up in here and do a search for IV percent and have that added into your column. As you can see with me, I always have this in here. As a matter of fact, I look at IV percent before I even look at what the stock is. I'll just try and find these, and when I'm selling premium or when I'm buying premium, you know, then I go to the bottom and just start looking at the IV percent before I even look at what the stock is. That's how important it is to me. I'm not beholden to what stock I'm looking to trade. I'm beholden to trying to find what the implied volatility percent is and go from there. One quick thing to just note, IV percent, what this is telling us is it's where the IV percent now is trading in relation to where it has been in the past. So the way that that number is figured is you take where the current IV is, and you have a numerator and a denominator. In the numerator, you take the current IV minus the low IV, take that sum and divide it by the sum of the high IV minus the low IV, and that's where that percentage comes in. The max IV percent is 100. Scott, yes, it is. But keep in mind, it can remain at 100. So for instance, like if we look at Lilly, which I've been involved in, you know, I sold like a call spread when Lilly started tanking, but IV started increasing on me. So with that, I don't usually leg into things like this, but I wasn't able to get really out. I was directionally right, but my calls just weren't decaying, right? So although I was directionally right, IV was increasing. That was hurting me. So when we got down around this value area, low area, I sold some puts and created a strangle on that, looking for IV to start to revert back to the mean. Well, you know, with the election and everything else and Trump surprising and stuff like that, all of the health-related stocks are starting to see implied volatility really go up. So I need to really have this come down. Even those, I sold those puts and high IV, the implied volatility continued to go up, and I just haven't gotten my theta decay. But once it starts reverting back to the mean, it will be pretty precipitous. Sorry, I'm getting some pop-ups here saying we've reached the maximum attendance record. Sorry for those who aren't here, I guess, didn't make it. So that's how that is. So that, I hope that answers your question. It can continue to be, this is continued to be at 100%. And the same thing on the downside, it can continue to be at 0 if it keeps continuing to go lower. But this is, you know, this will happen, but it's really, to me, overextended. But it is what it is. Did anybody else have anything? So, no, Mark, I would not, well, I mean, I would only avoid, Mark's asking, so would you avoid SPX and the rut? Only for one, we've gotten this vol crush happened already. But if it were above 30, which I don't believe it is anymore, then that being the case, I would avoid it. And what's the rut? The rut's 24. So yeah, it's below 30. And we've had that vol crush. I mean, that's why I was talking about, you know, the time to take advantage of this was right before and after the election when we started getting that real, well, that was a binary event. I talked about this in those daily market commentaries, so I hope you guys are all watching those. You know, I was talking about the election being a binary event, which is a known event that, you know, you're going to see implied volatility percent start to increase, just like it would be for an earnings. It was kind of like an earnings type of trade for the overall equities. Please discuss, I think that's characteristics of SPX, Iron Condors, or legs. How far away, short strike, premium, and demand. All right, I'll try and get into that. How about I do it with the QQQ? So just because I know the Qs have, or at least did have, isn't above 30 yet, it's above 30. So let's look at it for the Qs, because we've got the implied volatility above 30% because it is a basket of goods. And you know, so it's $100 underlying, and the next thing I do is I found my $100 underlying. Is it inside of 10 cents? Yes, it is. That's my big rule of thumb. Obviously, then the thing you can do is go and check volume and open interest on this. You can see there's a ton of volume and open interest. So that makes that good. Then the next thing I do is I start to look for like the 16 delta, because remember what I said about the 16 delta is the 16 delta is an 84% probability of being out of the money at expiration. So that's where I start this strategy, and I will always lean for going a little bit tighter. Usually the 20 delta is the one that really gives us the nice setup. So we'll sell the 120s, buy the 121s. And for those of you, I never go up here and do it this way for Iron Condor. I don't like the strikes that they usually give you, and you have to end up messing around with it anyway to get it the way I like it. So I just build it out. So click on it and then hold down Control and click on your next one. So I have the 16. I'd probably lean towards the 18s and build it out that way. It's $1 wide strike, right? So our call spread's $1 wide, our put spread's $1 wide, and we have 33 cents. So that fits those rules. 33 cents is a third the width of those strikes. Now, if you are going to roll it out, my rule of thumb with this is I don't really like to even collect more than really a third the width of the strikes, because the more you actually collect, the lower your probability of success is, okay? You have to have risk on the table in order to have reward. So keep that in mind. That's why I'm going with that 33%, the width of the strikes. That keeps us right in line with higher probability of success, all right? If you're collecting 50 cents, then, you almost have a 50-50 chance of success. Now we have about almost a 70% chance of success on this strategy. So that's why I kind of lean towards it that way. The least I will take is a quarter the width of the strike, and that's on something that's like $1 wide. Now, what I was talking about earlier is when we're starting out with a strategy, and if you're normally trading one lots in this strategy, okay, if you're a newer trader, or if you're trading 5 lots and you're thinking, you know what, I can handle this risk, I'm going to increase my size. Well, I want you guys to think seriously about this, is rather than increase your size and increase your risk that way, is to increase your risk by making these wider. It will make you, of course you're going to have more risk on the table because it's wider, and you have a higher chance of losing money because that bid offer gets wider. But ultimately, it'll get you more comfortable trading naked strategies, and naked strategies are really where you can start doing very well. So it just will get you a little bit more comfortable as you go along, taking more risk. And risk is reward, so keep that in mind. So if you're thinking about going from a 1 to a 2 lot, or a 1 to a 5 lot, or a 5 to a 10 lot, think about maybe, instead of doing that, making these a little wider, where I would then increase these to the 22 and increase this to, or decrease down to the 7. So now I'm $2 wide. And then at that point, we're still within that 25% to 33% the width of those strikes. Yes, I did mean wider. I don't know if I said tighter or wider, or if I misspoke there. And rather than increasing your size, increase the width or go wider, just like that with this strategy. Okay, that makes sense. Sorry, I'm getting some pop-ups. So this is the real takeaway. And then again, if you're trading this, you get a little more comfortable, get a little wider, but make sure your implied volatility percent is high. The other thing you can do with this strategy to just double check it, we've had some volatility in this. We can look at where our short strikes are, the 120 and the 109, especially if you're a charter. 120 on this is going to all-time highs. I think that this year we're going to start seeing a little bit more volatility in the market. So this strategy will be in play a lot more often. But 120, we're above the high. And what was the 109? That puts us way down here. So you can see that this has been a pretty choppy, in a sense, but trendless market. It's not really trending up and it's not really trending down anymore. We're really kind of stuck within this range, and that's exactly what we want. We're almost right in the middle of it. where the most time and volume's been spent, which is where the comfort zone is for the cues, and hopefully we can stay within that, and that's what we're going to look to do. Does that make sense for everybody? Fred's asking, when do you get out if it goes against you, double your credit, and when it hits a short strike? Fred, now because I know my probabilities of success on this are about 60%, I'm usually, because it's a defined risk strategy, I'm usually going to hold on to this one and let the probabilities work out. There's a high probability that I'm going to get tested on them, even tested on my break even with this one, but I'm going to let it play out. And the reason why, when we're selling this 20 strike, that means we have only a 20% chance of the underlying rallying up and settling above 120 within the next 35 days. But if you've watched any of my options hacks videos, one of the 4 trader hacks that we used to always use is double the delta is your probability of being tested on this. That meaning within the next 35 days, there is actually a 40% chance of the underlying rallying up and hitting this strike and maybe even going through it. There's even a 30% chance of the market coming all the way up and testing the 121 strike. Same thing on the puts. You double that delta, and that kind of gives you the probability of being tested on your particular strike. So that's a little option hack for you, a little shortcut. So double that delta is always going to be your probability of being tested, or them trying to put the thumb screws on you, if you will. But keep in mind, the probabilities are the probabilities, and over time they will work out. Now, if you really want to try and defend this one and it's going bad, you can always roll this into an iron butterfly to defend it, which would mean that if the underlying came up here and really started settling down, maybe even went above your long call, the market rallies up and goes above your long call, then you can take that put spread, because it's going to be worthless. You're going to take everything out of it that you possibly can, especially if something goes wrong really late in the game, okay, where you're almost at the point of getting this 50% of your max profit. You're thinking, all right, we got this, and all of a sudden we get a big move, and there's only maybe 15 days left in the options montage, or till 15 days to expiration. You can then be assured that this put spread is worthless. It's not going to help you. All it can really do is just hurt you if it really came back off, I suppose, but it's not going to help you. So you might as well put it to work. What I would do is then roll that up to where my short put is equal to my short call. So in this case, I would roll the 109, 107 put spread all the way up, and it would be like a 120, 118 put spread. So I have created an iron butterfly. That's another thing I love about this strategy, is it's very easy to be mechanical and be defensive. A lot of times with this one, because it's defined risk, I will kind of let it go. But if it's really late in the game and I've seen something bad happen to it, then that's when I will roll that down, or roll that up in this case, to create an iron butterfly. You can also just roll it up and just create a really tight Iron Condor by selling maybe like rolling the 109, 107 up to the 118, 116, and then you'd have a really tight one. But you'll be able to collect more credit by doing that, and that will increase your break even. So if you're collecting another, say, 30, 40 cents by rolling that strategy up, then that increases your break even by another 30, 40 cents. You can add that in as your total credit. What kind of cost, it rolled off. What kind of cost is involved with doing that? I mean, approximately what is your shortest period of time? Doing I mean, approximately. Do you mean what are my commission costs of doing that, or what's the cost of? You're probably going to be able to roll these. These are going to be like maybe 5-10 cents or something like that at that point in time. You're going to try and collect another maybe 30-40 cents or something. When you exit, do you leg out or exit as a complete package? Great question, stock trader. I will 99.9% of the time exit this strategy as a complete package. I got into it as a defined risk strategy as one package. I'm going to take it off that way. I rarely leg even into strangles. In that case of Lilly, I did leg into a strangle in that case. But the reason why I did that is because I was trying to defend myself in a sense. I was directionally right. I thought it was a little overdone and wanted to take advantage of a little bit more implied volatility, and did that by selling the puts. Created a nice wide strangle. But to get out of it, I don't want to leg out of it necessarily because I don't want to start increasing my risk. Because keep in mind, if I have to leg out of this strategy, I've increased my risk because I'm going to have to pay something to get out of that one leg, and that decreases my break even on that call spread all of a sudden. So I might as well look to try and take this off as a complete package at the same time. Do I do them mostly on ETFs? No, Fred. I usually will do this just as long as it lines up with my rules. I don't even really usually care what the underlying is. I mean, I will look at the charts. I'm not beholden to the charts, but I do like to see something like this where it's gotten some volatility cracks, and but will eventually settle down and start moving sideways. Does that make sense? How do you make a watch list of stocks, and how do you modify it with the market conditions? So this, I don't even remember how I pulled this up, but at the bottom, if you go way down to the bottom with Thinkorswim, you can punch something in here. So I could just do like, you know, Disney or something. Oops. If I wanted to put Disney in here, I could put Disney in there, and it'll do it. Now, the reason why it disappeared is because it filtered into where the IV rank is for Disney, because I have it sorted from high to low, and you can flip on that to there. To get this market trending thing, right here is a little gear with Thinkorswim. You can click on that, add in IV percent or the trend of where that is going. I don't really ever even look at that, to be quite honest. Oh, people are blowing me up today. I'm going to have to stretch out my questions box just so I can see it, because people are getting rolled off and I don't want to miss anybody. And you know what? Feel free to kind of throw your questions back in there if I haven't answered them. If you have a long call in trouble, would you consider selling a put to adjust the long call? On this strategy, I would just roll those, roll the puts up. How do you adjust or fix an Iron Condor that has gone wrong, like choosing that? I think I answered that. How do you adjust it? You basically are going to roll that up, and depending on how close you are to expiration, the closer I am to expiration, the more likely I'm going to roll that into an iron butterfly, which is basically having a short call and a short put at the same strike. How many days in advance do you shoot for? Right around between 45 and 35 days. I like 45 days, but 35 days is really where you start catching that theta decay. 45 days seems to work better because I have a tendency to be able to get that third to width of the strike a little bit easier than inside of 35 days for sure. This is Thinkorswim, somebody's asking. Let's see, I think I answered most of these. What makes you decide on doing an Iron Condor over a strangle? The less sure I am that the underlying is going to stay in a trend. That would be if I'm worried about volatility expanding and things of that nature, that's where I'm going to kind of put in an Iron Condor over a strangle. When I've seen the implied volatility expand rather quickly, like what we saw with the last week with the election, that's usually where I'm going to go with the strangle. The other thing is if I'm doing the strangle on an underlying that I wouldn't mind taking possession of with on the put side if it got put to me, that would be another situation. As a matter of fact, I did a naked strangle on Target last earnings, you guys, and I just finally got out of it for a scratch. I had I think it was the 78.5, 72 strangle for the earnings event. It tanked on me. I didn't get out fast enough and had to write it out. Just started rolling short calls against it, collecting premium, finally got out. So that's how I defend those strangles, and it will end up working out for you. If you roll to an iron fly, you still have 2 weeks of time left. That case, how much would you exit? At that case, if it came basically back down to my 2 short strikes, I'm going to be looking to try and cover that relatively quickly. You know, a scratch is a win, you guys. I mean, just like I got done talking about that target, I took a scratch on that and felt like it was a huge winner because it was such a loser for a while too. To roll, buying back the put spread and then selling another put spread to create the iron fly, same expiration. Yes, same expiration, and I do it as one trade. I buy in that put spread and roll it down to the or roll it up to the other put spread, which is basically just a condor in a sense, a put condor. What else we have here? Watch list I talked about. I made 35% overnight on a double diagonal in Disney. Nice. Disney took a nice fight yesterday, or actually today. When defending, do you ever go inverted? Yes, David, I have gone inverted on these, and actually, you know what? No, I wouldn't say I've gone inverted on the strangle. I wouldn't necessarily go inverted on this one. Because then you're kind of, I mean, it doesn't really work. I guess you could go inverted on this one if you could collect the full amount or enough money to cover the full width of your spread. So if it was $1 wide, you originally collected 33 cents, somehow you were able to collect 70 cents or 77 cents, then I might think about doing something like that. But I've actually, that thought only just, I don't know if it's possible to do that, but that would really be the only type of situation that I would do something like that. Would you consider selling a short strike at the high low or at the 16 delta? I'm not sure what you mean. I look for the 16 delta would be the best if I collect the 16 delta and then collect the third the width of the strike. But you know, then if that doesn't work, I'm moving towards the 20 delta to sell these. All right. Is the put spread credit usually less than the call spread credit? No, usually the put spread credit is more than what the call spread credit is. So I usually start by building these out. I don't know why my charts aren't coming up, but I usually start by building these out with the call spread and then add the put spread in afterwards. That's just kind of, I don't have a reason for that necessarily, but you're usually going to collect more for the puts because what happens is puts get bought up, and that's really what pumps up those premiums, and calls usually get sold because people are usually selling calls against their long stock that they own. So credits and calls usually get pushed down a little bit, which creates skew to the downside. So when you saw that picture of my bell curve, usually the bell curve is a little warped, if you will, because the puts have more premium in them, and you can actually usually get further away from where the underlying is trading on the put side than you can even on the call spread on the call side. So that's also part of that skew of the bell curve. So yeah, you're usually going to try and build this, and hopefully that the put side credit you receive makes up for the lack of the call spread credit you receive. Does that make sense, Mark? And I don't know that it has to do with the fact that the market is near all-time highs. Oh, I don't have anything in there. Is that why? So let's look at, do you guys want to look at another one? I think EA Sports was looking like it was a pretty good one. You know, and you could look at doing this one on Lilly. I mean, I may have gotten in a little early on Lilly. It's already had its ex-dividend, so it's not that big of a deal. But I already have a strangle in there. And I tried to look at the legs of it and create another Iron Condor around it, but my short legs would be, my short puts, excuse me, is where I'd want to be buying my other one, so I didn't do it. So EA Sports. So EA Sports is obviously had some, you know, volatility in there. It's got increased volatility. We're past earnings. Now that's another thing, you guys, don't do this like, you know, this month, you know, into this month, if this earnings were, say, right here, we wouldn't want to put this strategy on, because the idea is as you approach earnings, you can see volatility starts to expand almost every single time. And if you sell this in that type of environment, that's going to hurt you. You'd be able to have done it much better. Now you can do this strategy like right before earnings, which I actually have talked about on a webinar as well. But that's why we would love to see this volatility come out of it. So if we look at EA Sports, it's just below 46. I thought that was above 50 earlier today. GLD is another one that I was looking at. And GLD has seen some volatility with the market lately. And volatility, as you can see, is really starting to spike, and that's because they've sold off quite a bit. And, you know, it's kind of a flight to quality, if you will, where people are trying to jump in on the market rally and equities. But we could easily see this start to slow down and settle down, so it might be a good one to look at, depending on what your thought process is with GLD. And again, I would start to look at the 16 delta, see if we could do it with that one, and then start to roll it down. It's got tight bid ask. One thing I want to look at, I looked at the IV percent. It's high enough. You can see it right there. It's 60. Then we could see the tight bid ask. It's inside of 10 cents for the most part. It's over $100 underlying. So start with the 16 delta, 12 cents. So this is what we're going to be talking about, 12 cents there. If we can find the 16 delta, this is as close to it as I can find, 12. And then, so that one bucks that whole theory on what I was talking to Mark about earlier. But generally speaking, they are going to be more, you know, and that's a 15 delta versus a higher 16 delta. That could be part of it. But usually you will see the puts have a tendency to be the ones that carry the most premium. Well, I guess we could even look at it this way, where we are trading 117, let's just say, and those puts that we sold are the 109, so that's 8 away on that side, and the 125 you sold, I guess that's 8 away on the upside, so that didn't really help. But anyway, you will usually see the puts have, as a rule of thumb, more skew. So in this regard, I'll roll that up to the 110, try and see if we can get this to work out for us. 110, 109, 110, that didn't work out. So we wouldn't be able to do that. That's even less than the 25% the width of the strikes. So let's just start over and go closer to the market. The 119, the 19 delta and the 16 delta, which is the 124, 125. And then let's look at the 18 again. So we got 13 cents there. Hopefully this will give us it. Got up above 25% with the strikes, but it's not working out. So it's looking more like that. The Qs are the ones that was the best one so far. I think there was one, maybe even an ADM that I had. Let's look at ADM. Oh, we have a couple minutes. So ADM, again, no 16 delta, so let's look at the 18s. That's not going to give us any love. So the 19s, so 27. That's not working either. So, if it's, below 33 cents, you can put it on the short list. And then just go through a lot of them, make a note to yourself, okay, well, that one was close, and then try and find the one that fits the bill, like the Qs, that one worked out where we didn't have to go inside of a 20 delta, meaning higher than a 20 delta on either one of them. We've gotten our third the width of the strike, so that's probably the one. After going through all of my steps, that would be the one that I would implement after going through all these. Does that make sense for everybody? Don't just put on don't fall in love with a particular stock, you guys. Like, I love to trade this stock because I know so much about it. At the end of the day, play it like it's probabilities. Play it like you are doing this mechanically. Don't let the emotion get involved with it. Same thing with what I'm talking about, taking 50% of the max profit on these things. Make sure you stay mechanical and take little, they're like the little jabs. You're just jabbing the market, taking little punches at it. Pull a little out at a time. We're not going for home runs. Home runs strike out, right? Does it make sense? Anybody else have any real quick questions for me? Or have a stock that you want me to look at real quick? Alrighty then. This is my Wolfman's options course, you guys, and I know we've gotten a lot of sign-ups and a lot of newer traders in there. So this is a great one for newer traders and even the savvy trader. And if you've learned anything at all, if I've given you even the slightest bit of edge in trading, it's going to make up for this $36 price. I mean, this is a big reduction for the holiday season, I guess, for Veterans Day. Anyway, basically, I go through, a lot of people were asking how I set up my screen with the side. I go through all of that, how to set up my options screen, how to use Delta to measure your odds of winning, just little hints about even like that, double the Delta is your probability of being tested. All those little nuances that I teach you about those different Greeks, if you will, and how to measure time decay, increase your probabilities of success using it. Gamma, I talked about that a little bit. You can actually use Gamma to help you out and do little Gamma trading and stuff like that. I talk about that in there. A little bit of history of options. You can find out exactly who the very first person was that traded options, if you will, and really was the godfather of options. How to protect your portfolio with options. That's going to be really important, you guys, especially if you have IRAs and stuff like that with a lot of long stock in there that you want to protect that. It'll also increase your yield on those things. So that's, if you can lower your basis and everything else, that's great. How to basically sell options and generate income. That's the best way to increase your margin, you guys, or increase, not your margin, your yield and your return on your investment. With interest rates looking to start rising, you guys, most portfolios have 40 to 60% in bonds. And if you have bond ETFs and stuff like that in your portfolio, those things are going to get decimated, especially in IRAs and stuff like that, where some, maybe a financial advisor's gotten you into those, because those guys are constantly turning over that portfolio, right? And if they're buying bonds, high and selling them low, they're chasing yield. So they're trying to get return on that money, but in the meantime, they're going to get crushed on buying high and selling low, and that's going to be a real problem in many portfolios. So I show you how to protect that part of your portfolio in there. And trading options, or options tradings and dividends, stock splits, all of that stuff, and a bunch more. $36, you guys. I mean, that's ridiculously low. You can call us at 310-598-6677. So if you want to start learning to trade like floor traders, learn some of those little nuances, those hacks, this is a great opportunity for that. You can reach out to us at trading@protraderstrategies.com. Also, if you guys sign up for this, you guys get the daily market commentaries where I talk about every single trade that I do, when and where I'm getting out of them. I mean, I went through the whole thing with like Target. If you guys watch those daily market commentaries, when that stock got put to me, what I was doing to defend it, how I was rolling it out in time, lowering my basis on that, which was lowering my break even and increased my probabilities of success. I only had to roll it out 3 times, got to break even, and I could have even been profitable. I was just a little trigger happy on it and got out about 2 hours early, but it is what it is. Don't look back. And I even did it with Twitter when Twitter went against me too. So I talk about all of that stuff and every single trade that I do, how I'm defending it. I talked about the Lilly trade. All of those trades that I put on, I'm talking about it. When they go bad, I'm talking about how I'm defending them and when I'm doing that. So that's really important as well. Also at tradingprotraderstrategies.com, if you guys are, part of the course, you get unlimited access to me. So if you have a trade that goes against you, or you're thinking about a trade that you want to put on and want to talk to me about what you need to do, reach out to me, you guys. I have a no email inbox policy, which means I'm answering everybody's email, and I will do it as soon as possible, because I know what it's like when you got the thumb screws on. You want some answers, and you want them now. So I try and get back to you as soon as humanly possible. So reach out to me and take advantage of that. All right. The link for this course, you guys, is right there in the chat box. It's not going to come up in this questions box that we've been using back and forth, but it's in that chat box, and that's the easiest link to it. This is also the link for that webinar. It's basically protraderstrategies.com/options-courses/how to trade options like the Wolfman. You can't really click on this, but you can pause this video later on and write that down. Later webinars, we're going to be drilling down on options components, how to trade options, trades I find, and where I find them appropriate. Also, please reach out to us, and if you know of a strategy you want me to cover for you, I'm more than willing to look into it and talk about it. So thank you guys all for watching. Again, you can contact us at 310-598-6677 or email us at trading@protraderstrategies.com. Also, be sure to click on that link and get your discount, guys. I guess a lot of people are blowing me up, so I didn't realize my cursor was stuck. So I'll try and go back through some of these real quick JQ, sorry, I just got here. Can you start over? Good one, funny. Would you do an Iron Condor before or after earnings? I would do it right before the earnings. And if you watch the earnings webinars, I talk about that when I put those on exactly, try and take advantage of all the data decay and volatility crush that we get. All right. How many Iron Condors do you have on at any given time? I would say my portfolio is probably less than 25%, but I also have a policy for myself that I don't want to allocate myself to any one particular strategy over, like, 25% of my overall portfolio. I like to try and mix up the strategies. I mean, I don't like buying put spreads and call spreads, but I do throw those in, smaller quantities generally, but I do throw those in there just to make sure that, I'm not all beholden to just one particular strategy, because I try and get my portfolio either delta short or delta long. And now what I mean by delta short means that my overall portfolio is short. Like right now, or just recently, I was long deltas. I've just started covering a lot of things that were long deltas, and now my portfolio is getting increasingly short deltas, which means that I'm getting short the overall getting the overall portfolio short for bearishness. So and an Iron Condor is going to be usually delta neutral. So I usually kind of play back and forth with my deltas, and by doing that, I'm selling call spreads, put spreads, and different things like that to try and create a little bit of bias to my overall portfolio. And see, now I see a lot of people were throwing up stocks to run over. I'm sorry I didn't get to those. My cursor was stuck, and I didn't think anybody was blowing me up. Do you see the market rally or continuing into the end of the year? Scott, great question. I usually only try and look forward about a month or two, and just play because I'm playing in the option series. I just try and look at it that way. Everything can change in 6 months to a year. So the only time that I have that long horizon is usually when I'm long the underlying or long a synthetic of that underlying and trying to sell calls against it and stuff like that, lower my basis. But I usually don't look that far out. Having said that, if you put the thumb screws to me, I would say in the near term, I think we're due for another bit of a pullback. I think this big massive rally is a little bit overdone that we've seen in the past couple of days, and I think you could see a pullback. But by the end of the year, it looks like the economy is just kind of trudging along. It's just really going to have to see what policies are starting to come out of this new administration, really. What is the training media DVDs? It's online, so you basically can go onto the website and you'll have access to the course. You can go on there. You can check mark them to see when you're to show that you've kind of watched all of it, just to keep yourself in line, like if you're skipping around through them. And there's over like 50 videos on the entire course. I have well over 50 webinars on the website. This one has 20 plus videos or something like that. The one in this offer here has over 20 videos. But you also get the daily market commentaries, which is every single day. I do like a 10-minute video every day. What is your success rate, % of winners? Great question, DB. I would, here's the way I look at it. I spend about 10 or 15% of my time on my winners, and I spend about 85% of my time on my losers, like being mechanical, trying to lower basis, trying to increase the probability of success, rolling those out in time, and playing around with those like that. So, and one thing, as an educator, the SEC really looks down upon anybody that touts off any type of what my return is, like to show what my portfolio is and stuff like that. That starts becoming a situation where I am, what's it called? What's the word I'm looking for? Basically, I'm giving more advice, or I'm giving trade recommendations, which is a big no-no with the SEC anyway. Does the trading cover all spread strategies? I've pretty much covered every trade strategy. One thing I'd like to note right now is the Iron Condor is horrible as a debit spread. Don't ever do that as a debit spread, please, because it is a very low probability trade from the debit spread, which makes it a high probability trade when you're selling it as a credit spread. So don't try and flip the cards on that. Can you give us a breakdown of your portfolio percent allocation to each strategy? I don't know that I have a set, but I would recommend to you guys, don't allocate any more than 5 or 10% at most to any one particular underlying in your portfolio, and keep it under 25% for any given strategy, being 25% or less Iron Condors, and strangles would be a different situation. Throw some call spreads in there, put spreads, stuff like that, but don't get over involved in one just strategy. Mix it up. Do we need to sign up for the $7 trial, or is it already included? Scott, I think they'll take care of you there. Fred ordered the course. Thank you very much, Fred. I appreciate it. Have a great weekend. Can you give us a breakdown? That's allocation. I think I said that. How long does a person have access to your course? This right here is only for today, so that's your only access for that for today. But you will get all of the videos. Scott joined. Thanks, Scott. Appreciate it. I think I answered everybody's question, didn't I? Oh, Scott, reach out to us. We'll talk to you about that. On big movers, do you ever back ratio to defend it? Great question, Fred. Not usually, unless I'm setting it up that way. I do ratio spreads and stuff like that when I'm setting it up, which I actually have a couple of videos on that. All right, I think I got everybody's questions. Yeah, the Q, Mark asked earlier in your example of the Qs, put credit spread was less. Are we currently in unusual conditions? Yeah, that's the thing when you get that implied volatility coming out and we're rallying, and it seems like nobody's worried about the downside. We've seen the VIX go from 20-something down to, I think it was below 15 today. That volatility crush that happens, it means really nobody's buying any puts. And the VIX is really a fear indicator, and it has to do with the amount of premiums that people are, or the amount of buying in puts that's going on. All right. I think that's everybody, right? All right. I think I got everybody. ATR question. Oh, ATR. What was that ATR question? Using to select your short strike. You know what, Roger? I'll talk about that. I'll look at ATR on Monday. I'll take a note. I'm going to make a note of it. Will we get the replay tomorrow? I'm going to try and get this thing compressed. It takes about an hour or so to convert it, and then it should be being sent out pretty soon. Trevor, what do I use to determine whether a stock's going to go sideways? I usually will look at something that's had a pretty big move a lot of times, or just kind of bouncing in between support and resistance, kind of like I showed on that QQQ, where I look at where there's a couple of tops and bottoms and they happen to line up, and that's usually what I'm kind of looking for something like that. Dominic, reach out to us. It may very well be in there in this course. That's a really important one, the covered call one. So reach out to us and let me know. All right, guys, that's all I got for you guys today. Have a great weekend, and if you're a veteran, thank you for your service, and everybody go out there and thank a veteran for what they've done, what they've sacrificed for all of us. All right, have a great weekend. If you can't take that, take it easy.